Hi everyone, and welcome to the first part of our tax talk on international tax with our very own James Karanja. Welcome to this session, James.
Thank you very much. It's great to be here.
Thank you. Before we proceed, allow me to say a few words about your experience for our audience. James has vast regional and international experience working on tax matters, including issues relating to tax transparency under the Global Forum on Transparency and the OECD G20-based Erosion and Profit Shifting project, where he successfully led Africa's inputs. He has also managed various civil society projects in Africa, right, such as the Africa Initiative, that's geared towards promoting awareness and adoption of global standards aimed towards mitigation of harmful tax practices in Africa, which we will also get to probe him a bit more on this. James is also the immediate former head of the secretariat of the OECD-UNDP Tax Inspectors Without Borders, an innovative global capacity building project aimed at building transfer pricing capacity in developing countries. He has also served as head of International Tax Office at the Kenya Revenue Authority. So yes, welcome James, welcome again.
Thank you.
Great, so let's kick off with our first question. It is clear that illicit financial flows and harmful tax avoidance continues to have a significant impact on the development of African countries because it really affects revenue mobilization. In your experience, what would you say is the set of circumstances that are contributing to this sudden burst of, well, not so sudden, burst of illicit financial flows and harmful tax practices in Africa?
Okay, thank you for that question. I think the first point to raise is that illicit financial flows as a topic is very broad. It includes a whole host of issues, money laundering, and other related typologies of financial crime. However, I think for this particular session, focusing on harmful tax avoidance, I think I would say one of the critical issues has been around lack of a coherent, multilateral discussion or framework around which cross-border taxation issues could be addressed. For the longest time, this has been a challenge, and Africa has experienced, with all the globalization, the global supply chains becoming very focused on the multinational enterprises coming into Africa and exploiting the loopholes between countries' tax regimes, exploiting the tax treaty network in a way that wasn't intended to actually avoid payment of tax in Africa. So it's a huge business, huge investments into Africa, but very little in the way of tax because of all the gaps in the international tax regime, which have certainly created a challenge that Africa is not being able to fully benefit economically from the companies that are operating within Africa. So clearly huge challenges for Africa, but certainly also opportunities there once some of these issues can be resolved.
Yeah, and I mean, speaking about some of these challenges, really, then the key question is then, what initiatives are being taken up at the continental level to curb illicit financial flows and harmful tax avoidance?
Yeah, so sadly, there isn't much in the way of the African-led processes. I think a most well-known initiative is probably the Thabo Mbeki high-level panel on illicit financial flows, which is an AU UNECA-led initiative, which has been largely around discussions, building political understanding around these issues, but at a technical level, I think we have the Africa Tax Administration Forum, not a policy body, but doing a lot of technical capacity building for tax administrations, helping them with legislation, and then obviously with the support of other development partners and programs such as the Tax Inspectors Without Borders project that we're running that helps countries on building audit capacity on transfer pricing. So I think from an Africa-led perspective, clearly there's a lot of gaps, perhaps I would say lip service from such frameworks as the Agenda 2063, which says very little on how to address these issues, and the AU Commission itself with its own secretariat limitations on the ability or the capacity to develop frameworks for Africa, much in the same way as OECD would develop those frameworks, say, for their member countries. So what does that mean? It has led Africa now to have to be following other processes of the OECD, the BEPS inclusive framework, the Global Forum on Transparency that is seeking to address some of those issues. Obviously, with those limitations, that, you know, something that you do not lead always has those challenges about how much you can input.
Yeah, it's amazing that you know, there's a lot of work going on at the global level,
right,
which then turns my attention to now the OECD inclusive framework on base erosion and profit shifting. And so could you give our viewers a backdrop, or rather a background behind why is there this deep desire by many countries to, you know, institute reform at the international tax level, and did this happen before, or what set of circumstances led to this, you know, deep drive and motivated desire to institute reforms at the international tax level?
Yeah, so obviously the last 14-15 years have been a watershed period in the international tax reform. Prior to which, I think for over 100 years, the conversations have been ongoing that the international tax system is broken. But I think what happened, the watershed moment, is actually in 2008 with the global financial crisis. And the big discussions then around government having to bail out corporate organizations that were too big to fail. Now, clearly that led to also some public backlash that if we are going to be supporting corporates, they're too big to fail. A lot of people went into foreclosure, for instance, at an individual level, but the corporates were allowed to continue even on the back of other taxpayers. So the question then became, so what role suddenly are corporates playing also in paying their fair share of tax? And these issues were clearly also buttressed by a lot of information leaks from the tax havens around the practices or the malpractices of these corporate entities in sheltering their incomes from taxation. And so I think it really became at a time when the G20 was established to reform international institutions, that then the political moment came that these issues now could be addressed. So what we've witnessed in the last, as I say, 14 to 15 years is quite intense push on issues such as bank secrecy, enhance tax transparency of financial information, on beneficial ownership, on measures to address specific challenges within the tax system that multinational enterprises have exploited so as not to pay tax in any jurisdiction.
Yeah, I mean, and thanks for that, James. And so on the back of that, really then, given the extensive reform and extensive deliberations that are happening at the international tax level, then the next question is really, what role are African states playing, right? And if there's a role that they are playing, are there any hindrances that, you know, affect their full and effective participation in these deliberations?
Yeah, so African countries, as I say, first would be faced with the fact that they're not key players in these discussions, largely because they got brought into this process fairly late. I think these were G20-led processes, and the OECD countries, some of which African countries joined fairly lately in the process. And also you have a huge challenge that these issues sometimes have they're bound with a lot of complexity, of which many African countries are not, didn't find themselves able or competent enough to participate. So you would have people sitting around the table representing their countries, but with very little to say. So we had a lot of African joyriders, as it were, in these discussions. But what I really appreciated is that when, with a lot of preparation, a lot of deliberation, is that African countries did actually get to lead input into the BEPS process, not just supporting African positions, but supporting developing countries' positions. They are today on the steering group of the BEPS inclusive framework, and their membership there obviously has ensured that some of the things we see focused on supporting or mitigating impacts for developing countries, that these issues are now sort of at the forefront. There's some friend who once said that if you are not seated at the table, you're part of the menu. So that push, I think, for African countries to be seated at the table, where now they would be able to defend their own interests.
Yeah, amazing. So if I may kind of segue now on the back of that, extensive deliberations. So no doubt, multiple action point reports, domestic model rules that are to be incorporated domestically by, members of the inclusive framework. Now, on the back of all these changes in the law and, a lot of compliance obligations, in your opinion, how can businesses in Africa address the ever-growing compliance obligations, and similarly tax administrations as well, to kind of, build their capacity and, be able to keep abreast with all the new changes in the law that is taking place?
Yeah, so like you say rightly, the sort of changes have been quite difficult to keep up with, even from a practitioner level. If you were a person specialized in tax treaties and those are the changes you are focusing on, then you lost complete track of everything else that's going on in the other areas of the BEPS action plan. If you're on the pillars now, there's quite a lot that's been happening, and it's very difficult. I think to keep up, clearly there's need for a lot of awareness building. There's need for greater sensitization. I think before all these developments can sort of settle, it's really important that businesses invest in getting to better understand what has happened, and also to be able to readapt or change their practices in their business setups in line with to be able to correspond or to comply with the new regime. So professional assistance will certainly be at the core of businesses being able to comply. And we're privileged, I think, from the perspective and our experience, both from the policy making side, the tax administration, now into business, that at Anjarwalla Khanna we have that privilege and opportunity to assist clients to be able to better navigate the sort of challenges or complexities that come with all these changes, because of our African footprint, our ability to, advise business across really, and also we obviously have operations in the UAE as well. So that, I think it really lends. It's important to have a professional advisor who can offer you quite support in this area.
Yeah, and how, in essence, transfer pricing is really a big issue that affects, related party transactions. So as we now go into the issue of transfer pricing and all the changes that are happening in that space, could you please give our viewers a brief overview of what transfer pricing is and why is it so important?
Yeah, so transfer pricing, is important from a country perspective. Why? Because first, within the global context, is that businesses are now being conducted largely between related enterprises, huge. The supply chain globally seems to be over 50%. They say is between related enterprises. Huge business are now running across multiple jurisdictions, and so the issue of whether a business is able to decide where to report its profits clearly has an impact on how you price, for instance, your goods, how you price intergroup services, how you price intergroup loans, and such other transactions as, for instance, the payments for use of intellectual property. So this become critical that any tax administration wants to see that those transactions have been conducted at an arm's length. What that therefore means is that every business that meets those requirements must, of necessity, prepare transfer pricing documentation to evidence that the transactions they've done are at arm's length.
And then, if I may jump on the arm's length principle that you've just mentioned, we're continuing to see that the arm's length principle is being expanded, right, to cover, not just transactions within the same state or transaction with preferential tax regimes, but also in certain instances extended to transactions between unrelated parties. So with this continuous evolution of the application of the arm's length principle, then what is your opinion on how businesses have been reacting to it, and and whether this is really tenable?
Yeah, so I think we must understand first from the side of a tax administration why a policy like this would be important is that oftentimes transactions between a business and entities in a preferential regime, it's that much more difficult for these tax administrations to access information to determine, one, whether these entities are related for purposes of transfer pricing, and even once you establish the relationship, whether you then have access to information about those transactions. So this policy obviously is first to say that if you undertake transactions with a business in a preferential regime, that it is immaterial whether you are related or not. CARI do not need to prove that. But that you then, the onus is on you to prove that the transactions with that entity in the preferential regime are at arm's length. Obviously, that also has implications if that is domestic, because you also have preferential regimes locally, whether it's the special economic zones, the export processing zones, that it's possible to shift your profit between a business that is doing, that is conducting its operations within sort of the domestic setup, and then you have another one within the special regime, and that you can shift your profits over to that entity that has does not have tax liability. So clearly certain structural issues there that they are saying they would like to ensure that they safeguard revenue. But for businesses, what does that mean? It just means for those that fall within with those requirements, to then do what is required of them and just ensure that they've met the obligations to document such transactions.
Yeah. All right. Thanks so much, James. That brings us to the end of part 1 of this tax talk. Stay tuned for part 2. Thank you.